Hey traders, welcome to Top Tier Outlook. We're going to take a look at what are levels and lines and trends that we are going to deal with likely for the next week. This week's going to be a shortened week. It's a 4-day week. Good Friday is on Friday. That means OPEX is on Thursday. We have 4 sessions to basically process everything that's happening right now. Obviously, nothing bigger than the tandem narrative of yes, there's still plenty of tariff uncertainty. And yes, many of the daily time frames of the different indices are still in downtrends. But more so than that, not only are they in downtrends, as I can show you here, based on the structure of the daily time frame, they're also below some key levels. In this case, the anchored volume weighted average price. This is anchored to the beginning of the year. And then also the top tier dots, which is another level that I use to understand sentiment. In this case, because we're below those dots, that is bearish, kind of the bearish hemisphere, if you will, the bearish side of price expectation and movement. Another thing that we had on the S&P last week was darn close to a mean reversion. So these 3 lines, this low, this close, and this high of the mean reversion, it gives me a nice zone. We almost got to that level right here on the high of April 10. Really darn close. That mean reversion would be resistance, and I would only consider a mean reversion as a valid resistance level in the context of a downtrend. In fact, the indicators that I'm using, once the trend is gone, so too is that mean reversion window. And that's one of the things that's done by design, so I'm not thinking about a level necessarily if it's not valid. And you can see the last mean reversion, we hung on to a little bit of the trend, and that did kick in pretty darn well. This one's been still steadier. This one's a steadier one than the previous, but the previous one, as you can see here, we were just trying to come out of the trend until I have 2 gray segments of that trending tool. I'm going to presume follow through in the direction of where we came, or what I like to say, trust the trend that was. So if I'm looking for the possibility of a reversal, I'm not going to really be considering that a high probability outcome. If I'm looking at a bounce like that within the context of a downtrend, it's the continuation that I'm looking at the most. I'm always going to remember no one knows what's coming, including myself, anyone else for that matter, but I can look at probabilities. I can look at what's the most likely outcome, and that's where respect the trend that was is so helpful. All right, so this is what's happening on the ES. We're coming off a darn near mean reversion, rejection, and I would still remain quite bearish. Now, if the ES is moving lower, I'm going to look for more weakness in financials, healthcare, technology. Let's talk about financials for a moment because we're heading into earnings season. And in terms of the movement lower in financials, there's 2 major stocks in this group. One is Berkshire, so BRK. And that's the number 1 weighted stock in the financials. For the most part, traders will focus on JP Morgan, Bank of America, Wells Fargo, Visa, other high concentration weighted stocks. I don't tend to trade Berkshire. I'd rather, frankly, buy and hold it, but it is the number 1 weighted stock in financials. And if there is a stock in the financial sector, which is the number 1 weighted sector in the Dow, the number 2 weighted sector in the S&P, it's usually financials that's going to, interestingly enough, maybe have weakness across the banks and MasterCard, Visa, and other things, but Berkshire can oftentimes do its own thing because it's not really a bank stock. It's influenced, obviously, by bank stocks, but it's not a bank stock per se. And yet, oddly enough, it's the number 1 weighted stock in the financials sector. This is why we have to respect what the actual composition of these ETFs are. All right, so I'll be looking for the most part, on a daily time frame, a lot of heaviness. But let's open this up to a longer term view. If I take this chart and I go way out to the weekly, I'm not bearish on the weekly. If someone were to say, Raghee, if we have a 20% pullback, can we start looking for volume ledges? Can we start looking for reasons to want to buy stock with that far longer term outlook? I mean, look at this gorgeous volume ledge right in here. Respect the trend that was. So we're neutral now. I had the 2 gray segments. Now I have a third. This is a neutral trend now. right? Each one of these candles broke the trend that preceded it on the weekly, but look at the trend that was. What's the likely probability of this pullback outcome, even with all the volatility we're seeing? It's likely to the upside, and that's what I'm going to trust. And if you have a longer term, time frame, that's exactly what you want to do. You want to focus on not where we're going to be looking at a weekly chart 6 days or even 6 weeks from now. Where are we going to be 6 months from now? Where are we going to be even 6 years from now? And then that kind of begs the question, Rob, when's the last time we had a pullback like this? The last time, take a peek here, 2022. 2022. And this is JP Morgan. This was an over 20% pullback on the indices. You can see this on the ES. You can see this on the NASDAQ. 2022 was a 20%. Now, it wasn't a fun year to trade. It was actually pretty difficult compared to 2021, which almost had a 2020-esque rally. Because remember, after the Federal Reserve adjusted monetary policy in the wake of the pandemic, you remember what 2020 was like. And then 2021 did the same thing. 2022 was a reality check for a lot of traders who maybe, if starting in mid to late 2022, maybe during shutdown, started trading, never had dealt with anything but uptrends from March, April on until we got to January of 2022. And then it was a rude awakening. Markets just don't go straight up. Hard to convince somebody of that if they started trading in 2020. Now, 2022 just reminds us that choppy markets are difficult and they're going to happen. And sometimes pullbacks of about 20% can take 9 months instead of less than 9 days. I mean, this happened in a matter of 3 or 4 days. So the 20% pullback we have now isn't that it's more than we've ever seen. It's faster, right? This was a far slower and maybe arguably painful move to the downside. This was far swifter. I'll tell you, I like the quicker move to the downside. It actually reminds me a little bit more, not that we're going to have a V recovery necessarily, but it reminds me a little bit more of those pandemic 2020 lows. The reason that we're unlikely to see a V recovery, if we're talking about top tier outlook, if we're having a bigger picture conversation, is remember the adjustment of monetary policy, both by the Federal Reserve and the Treasury, was historic, right? We're not looking for that this time around, although we are heading into rate cuts. That brings another interesting perspective, again, to a longer term view. This week, again, 4 trading days, it's probably going to be best to focus on rallies to short into in downtrends, and then focus on overall uptrends like gold. We have a long position in Coke, in the Sector Secrets Mastery. None of these positions that I'm going to talk about here, just for a moment, whether that would have been our gold trade from a little bit ago. We've been in and out of gold quite a bit, whether it's day trading, whether it was swing trading at the end of January, whether it was more swing trades as we've cruised through what has been just a historic run in gold. The day trades have been great. But what about things like Coke? All right, this isn't in an uptrend. Why look at rallies and things like Coke? Well, staples tend to be defensives. Utilities tend to be defensive. But what I want to remind everybody is this isn't about just buying and buying. Realize this approach is reckless at best and a lot of luck. Well, I should say reckless at worst and a lot of luck at best. The post that changed everything rallied a lot of stocks that probably were not going to rally. So I'll take being lucky over good any day of the week. But what we want to remember is, for example, with our trade with Coke, we wanted to get the confirmation that the buyers were back and now they're offering support. So this way, when I put a trade on in Coke, I'm not typically risking any more than about 3% of my account. And I'm typically not in any way adding to this position that exceeds 3%. That's what most traders do. Sadly, right? Well, it's got to bounce. Think about what amateur or maybe inexperienced, forget amateur and professional, inexperienced and experienced traders. Inexperienced traders will say things like, well, I'll add to the loser. Inexperienced traders will say, well, I'll move my stop. Inexperienced traders will say things like, well, it's got to bounce, right? And experienced traders will say, well, how much risk to my account does this present? Experienced traders will say, all right, well, how do I know when I'm wrong? And what they'll do is usually wait for a setup that confirms that there's a manageable amount of risk from that level. And that's why we're long Coke. So a lot of these are going to be a little bit more, naturally, you should be slowing down your rate of trades. You might say, Rog, but if I'm not trading, I'm not growing my account. Well, granted, but if in this period of time, let me take you back to 2021 for a moment. How many people do you know, right, were kind of maybe a little reckless in 2021, and they probably got a little cocky and a little too comfortable in what they were doing. It takes a lot to rewind back to 2021 here. And then all of a sudden, 2022 hit. So all I'm saying is if we build bad habits in a volatile, choppy environment right now, saying, well, just keep buying and holding it because eventually it's going to rip higher. Remember, it doesn't have to. And so this is where, if you've never thought about it before, and this is something that's very important, and we teach this in the mastery, unrealized loss. How much unrealized loss on a trade are you taking habitually? Unrealized means if you bought something for $1 and you're willing to risk 100% of what you paid, you're okay with that option going to zero. And you think as long as there's time to expiration, it could come back. And that's true, right? And a lot of times, more an amateur move would be to continue to add to that position with the belief it could come back. But when you're trading a unit, an option, a thing that is a depreciating asset, if you have shares, very different thing. Warren Buffett commonly talks about, buying something, holding it, even if it pulls back 50%. I don't know that I agree with Grandpa Buffett on that note, but we're also having to remember that he's done a lot of research on that company, and he's looking at it from an ownership perspective. In fact, when Buffett buys something, he does have influence over what these people are going to do. I don't have influence over the stocks that I might have in a position trade. And so 50% pullbacks the value are unacceptable for me. One, it's tying up capital that I could be maybe doing something more productive with. And two, it just breaks the rules of good trade management. Because if I'm going to sit through, say, a 50% pullback, I've got to make from the entry price at least 50% of what I made. So if I buy something for $100 a share and it goes to $50 a share, the back of my mind, I've got to think it's realistic for that stock to get to $150 a share. Otherwise, I'm not operating with at least that one-to-one risk reward. And that's where I don't say I'm an investor, because I will apply trading opinion, trading strategy, trading risk management, my trader's mind, even to my position trades that I might hold in many cases now for decades. I think, Rod, you can do that? That's the only way that I know how to do it, right? Because for me, even if I'm going to hold that position for 20 years, it's still a trade. There's still exits. There's still risk to the account. There's still targets. And there, yes, is going to be a stop loss. And those are things that I think that if we can apply that to our longer term opinions, to our longer term positions, it's going to serve us really, really well. And that's where I'll say, even when I'm taking this longer term approach and we're looking at some of these weekly time frames, I'm thinking of those positions absolutely like a trader. All right, what else am I looking at right now in terms of interesting markets, aside from things like gold that are moving straight up that I would love to keep buying? We've been in and out of gold many, many times over the last, like I said, our first long position in gold, we got long in the mastery, was January. I want to say June. January of this year. January 27th, to be exact. Some traders bought GC. Some traders bought MGC. Those are the futures contracts. And others bought GLD calls. And we've been in and out of gold for a while. Now, what about crude? Crude is not enjoying a lot of bullishness here. And I would be very, very careful with crude until we can either shorten the time frame and find somewhere where we have a nimble approach to crude where we can control the risk, or I don't even like the longer term view of it. So I'm going to leave crude alone for a little bit. There's an interesting volume ledge sitting at about $53 a barrel. But I am not liking what I'm seeing here, and I'm going to be patient. I'll sit on the sidelines until crude presents an entry that I can manage risk from. And that's probably the most difficult thing traders have to do. Not the patience to wait for the trade, the patience or the knowledge to see the setup and then wait for the confirmation of the setup. Right? So we make a lot of trading, but let's talk a little bit more about setups. Right? And trading itself. You'll never hear me call myself a full-time trader. What does that even mean? That I'm here from 7 to 7? I mean, we're eventually going to have 23-hour, 24-hour markets, right? What does that mean? I just trade 24 hours a day. For me, trading preparation, the watch list building, understanding risk to the account, doing all that legwork that precedes the actual trading, the buying and the selling, that's kind of a full-time job. And I could spend hours every week talking about what my watch list is, what the proper risk management in terms of account risk and even contract risk would be, and fine-tuning which setups look probable. That could take a long time. But the actual trading should be thought of as a part-time gig. In other words, the hours spent doing it should be fewer. Fewer hours spent trading usually, for most traders, map to better results, because being in front of the computer more doesn't necessarily equate to better results in account growth. That brings us to another huge thing. Unless you're finding stocks like GLD, GDX, GC futures, unless you're finding things that are moving higher, this is not necessarily a great account growth environment. Can you do it? Yes. Are you likely going to have to operate with a riskier risk reward? Are you going to have to sit through more volatility and position size accordingly? It's doable. But if you're finding yourself right now still in the same kind of account growth mindset that you had for maybe most of 2024, that's a mistake, because this is not a great account growth oriented time. Sure, you can do it, but how you do it matters more. Going back to, are you moving your stops around? Are you risking more of your account per trade? Are you adding to losers? There's plenty you can get away with for a short period of time. But if the goal is account growth, which is not all of our goal, if the goal is account growth, here's the surest litmus test to it. A lot of times traders will make a lot of focusing on small accounts because once upon a time, I think everyone, either because they were learning and it was prudent to use a small account, or that was the capital you had. A lot of us are in a small account, but no one chooses to stay there if they have the knowledge to build a watch list and manage risk. The reason traders stay trading a small account is because they haven't mastered one thing. And you know what I'm going to say? It's risk management. They haven't learned that scalable mindset, that what should work in a $5 or $10 or $15,000 account can work in a $150,000 account. Otherwise, they wouldn't stay small, right? So it's not that they can't trade. It's not that there isn't a strategy that works, but the type of risk management won't scale. And that's where a lot of traders, again, get into a lot of trouble. So I want everyone here to realize, is this a great time for account growth? No, but you can. And will the trends resume? Absolutely. Is this time different? Probably not. And I'm not saying that in a way that's being Pollyanna. I've just done this for a long time, as have many of you. And yes, the details may change and the recovery might be different. But at the end of the day, does anyone really think the S&P is not going to turn into an uptrend again at some point? And does anyone really think that a 20% pullback historically hasn't been a blue light special sale? And those are the kind of things that, when I think about Top Tier Outlook and I'm sitting here in the office on a Sunday, that's kind of what I want to make sure I'm orienting to. If you've been watching Charts and Coffee and any of the free videos that I've been doing throughout the last few weeks, you'll see that I've been presenting a lot of data. Last week, we did a deep dive in the 2-year and 10-year. I believe that's sitting at the Simpler Trading YouTube channel. I've done a lot of data on VIX, what the VIXs look like when it has, here we go, here's another one. What the VIX looks like when it does go full tilt, and what the forward S&P total return 1, 2, 3, 4, 5 years later is. Again, let's not succumb to this time is different thinking, because frankly, it's likely going to cost us a lot of money. Be cautious, know your setups, find the trends, make sure you're focusing on the time frames that are best for it. It's okay to be a little inactive. I'd rather be a little inactive, have some sporadic wins, and not have to dig myself out of a hole by trading too actively in this time, or here's what's even worse. I'd rather not build habits that seem to be good habits because, oh, we're growing an account, but it's not a scalable habit. Those bad habits are really hard to unlearn. And what are those bad habits? Moving stops around, adding to losers, and risking more unrealized profit than what you're making. Traders will commonly risk 50, 60, 80% of their options while adding to eke out maybe a 20 or 30% gain. Now, if that's a one-to-one risk reward, great, but we all know it's not. And that's what I say. It's an insidious habit that will eventually gut your account, and it will certainly keep you from consistent account growth. Meaning today you're trading a $10,000 account, excellent. Can you take those habits and apply them to a $100,000 account and still take those types of tactics and make it work? And I think just as we're sitting here talking about it, you're probably thinking, yeah, Rog, it really doesn't work. Don't take my word for it. Go read things like the Market Wizards. Read about the legends. Read about people who have been doing this at a huge level for a long time. And you'll realize the one thing that they emphasize is risk management and position sizing. And right now is a great time to continue to focus on that. We're going into earnings. We're taking an already volatile period of time, and now we're adding another psychological volatility event to it. But we're still in a bearish environment on the daily. There are a few examples of 1 hour uptrends. So if you want to be a little nimble, but make sure you're not taking a 1 hour trade into earnings. But if you want to be a little nimble with that, go for it. Those weekly time frames and the day trades. This is what I've been saying for weeks. This is what we've been doing for weeks. Put on those longer term positions with that 6 month plus time horizon, and then day trade. And the day trading's actually been pretty darn good as the volatility starts to normalize a little bit. All right, gang, as always, thank you so much for being here for Top Tier Outlook. Remember, we always have at least four, for me, at least 4 different strategies that we can choose to use in any given time. We can day trade, we can short-term swing trade, we can long-term swing trade, and we can position trade. And right now, it's the day trading and the position trading that are really, really, at this point in time, the most productive. Be good to each other. I'll talk.